Continuing topic 3, paper 9, we're now going to consider the different types of warrant. There are two types, equity or subscription warrants and derivative warrants. Now let's just run through the points. We're told equity warrants carry the right to subscribe for the underlying stock of the issuer. That is the issuer of the warrant as well as the underlying. Although warrants are less certain as to the funds raised in the future than rights issues, there will generally be no immediate dilution effect to shareholders. That's important because when the option is exercised, there will be share dilution. They involve physical delivery of shares. Expiry for equity warrants is between 1 and 5 years. Remember that. Exercise usually follows American style, so it's any time up to and including expiry date, although European style warrants are also available and they expire on the expiry date, or rather they're exercised on the expiry date. Now, dilution of shareholdings occurs when warrants are exercised as new shares will be issued. Please be aware of that, because with derivative warrants, there is no share dilution. Holders are not entitled to dividends, another point that you should be aware of. Now, with derivative warrants, they are not issued by the company whose shares are the underlying. It is by other organizations, usually investment banks or financial institutions. They are exchange traded as with subscription warrants, and the expiry for derivative warrants between 6 to 9 months. The majority in Hong Kong, we're told, are settled in cash. So a large investment bank does not go into the market to buy the stock so that it can settle the exposure with the holder of the warrant. No, they will just pay the difference in values. A derivative warrant, unlike a subscription warrant, can be call or put, so they can have an obligation to buy or sell. Derivative warrants, the physical delivery are for shares that are already in issue. So as I said, there's never a diluting effect on the shareholdings, even if they went into the market and bought. May be issued over other assets, such as currency or commodities. And in Hong Kong, we have index warrants, basket warrants, and single stock warrants. Now, with regard to issuing the derivative warrants, the requirement for the issuer has to be a substantial financial organization, not a private company, because of any risk of default. Net asset values is specified there, not less than 2 billion Hong Kong dollars, and the institution must have the required credit rating or be regulated by the SFC, Hong Kong Monetary Authority, or be a government or state. Now, that's requirements for the issuers of derivative warrants. Requirements on the underlying assets with regard to derivative warrants starts at top of page 3.9. The underlying assets may be stocks listed in Hong Kong or overseas, a basket of stocks, indices, foreign currency, or commodities. Underlying stock of a warrant must be either in the Hang Seng Index or on an eligible list, which is updated quarterly by the stock exchange. Bit of detail here. And if capitalization of shares in public hands exceeds 10 billion Hong Kong dollars, the stock exchange may waive eligible list requirement. Okay, so that's requirements on the underlying assets. Now, if you are issuing derivative warrants, you must have a liquidity provider so that for each warrant issue, can only be one liquidity provider. And what do? Provide continuous quotes or quote requests from 5 minutes after the market is open, provide liquidity for at least 10 board lots of warrant, specify maximum spread between bid and offer price in the listing document, specify in the listing document the response time for each quote request. Now, the reason for this is that some deep out of the money warrants may not be traded, so you cannot get out of your position, and that's why the specification of liquidity providers has been put forward. Why would you invest in warrants? Well, we've got advantages and we've got drawbacks, and this is the type of thing that could easily be examined in a question. Advantages of investing in a warrant, well, it suits investors with longer term views. You're looking at 1 to 5 years for subscription warrants, as they have, as I've just indicated, longer expiry periods than options. They're available over baskets of stocks, providing exposure to some sectors or subsectors. Now, drawbacks of investing in warrants. The supply is controlled by the issuer, and so market prices sometimes can be distorted by supply and demand imbalances. Short selling is not possible for exchange-traded warrants. Please be aware of that. That's something else they like to examine now and then. Okay, let's consider OTC derivatives, that is over-the-counter equity derivatives. And they all share a number of characteristics. There they are, top of page 3.10. They're flexible products, can be tailored to suit the needs of counterparties. Well, that's the case with most OTC derivatives. Generally traded decentralized marketplace, so it's really traders at their desks trading with each other. There are no exchange-based trading rules nor margin requirements. That is correct. It's classic OTC market. No clearinghouse acting as central clearing counterparty. Therefore, you are faced with counterparty risk or credit risk. There is no guarantee from a clearinghouse. We're told the most common OTC equity derivatives are equity-linked debt investments, equity swaps, and OTC options and warrants. Let's look at these in turn. The equity-linked debt investment, reasonably straightforward. We're told they usually involve purchasing a debt instrument and receiving payments, coupons, based on the performance of a stock. For example, or stock index. For example, 10 million Hong Kong dollar 10-year debt could have annual periodic cash flows based on year-on-year performance of the Hang Seng Index. So if the index increases 10% for a year, the investor would receive 10% of the debt. That is $1 million. So it's not just a fixed coupon, it's linked to the performance of the Hang Seng Index. That's an equity-linked debt investment. Then we look at equity swaps. Similar to interest rate swap, but the equity swap will involve the swap of cash flows, specific period of time, linked to the performance of a stock, basket of stocks, or stock index. Now, it makes a lot more sense to look at an example. So we're considering a situation where one party swaps cash flows for a portfolio of short-dated debt securities for the returns of an equity index. So I've set it up so we've got Careful Limited and Ambitious Limited. Careful Limited has a portfolio of fixed rate investments. Ambitious Limited has a portfolio of Hang Seng Index stocks. Now, they could set up an equity swap whereby Careful Limited pays Ambitious interest rate received on the fixed rate investments, and Ambitious in turn pays Careful the Hang Seng Index return. Now, why would you want to do that? Well, that would be in a situation where Careful thinks that the Hang Seng Index is going to do well, and Ambitious is not so confident. So Ambitious may well think the Hang Seng Index is going to fall. Obviously, the two parties have to have different views on the market. And we're told at the bottom there, equity swaps enable parties to swap returns on their portfolio of investments to better suit their needs and views of the market. And a question can pop up where they can give you a scenario and ask you what is the best solution to hedge risk. And it could well be an equity swap that they're looking for. Okay, continuing with the OTC market, over-the-counter options and warrants. And this includes, as with exchange traded, includes calls and puts on equity indices, individual stocks, baskets of stocks, but it's between two parties. You're not going through the market. Usually structured in a similar way to warrants traded on an exchange. They can be vanilla or exotic, and an exotic equity derivative has more complex payout structures, and they're traded on indices, stocks, baskets of stocks. Now we come to section 4 on new structured products. Now, will this be examined? You might get one question picking out one of these products. You certainly will not be examined on them all. So I would read through it and do a number of questions to get you up to speed. We're told the most popular new products in the Hong Kong market over the last few years: equity-linked notes, equity-linked instruments. What is the difference? Well, the note is over the counter and the instrument is exchange traded. That's a very immediate difference. Then we have range accrual notes, callable bull-bear contracts, and accumulators. Now, the different products vary in terms, and they vary in terms of whether the embedded options have knockout features or not, time period and frequency at which options can be exercised, and special features that are unique to a particular product. I'm going to run through these reasonably quickly and just emphasize certain points. I wouldn't spend a long time trying to get to grips with the detailed workings of some of these instruments, products. So with the equity-linked note, it can provide a higher yield from the option premium generated by selling either a put option or a call option of the linked underlying asset. So you have this note, which is essentially a debt instrument, plus the buying or selling, I beg your pardon, the selling of either a put or a call option. If an investor sells a call option, the note's described as bearish because you're expecting the market to go down and you will keep the premium. If an investor sells a put option, the note is described as bullish because you are expecting the price to go up. So bearish equity-linked note, purchasing a note and selling a call option. Bullish equity-linked note, equivalent to purchasing a note and selling a put option. Now, some notes are listed on the stock exchange, but most are traded over the counter. That was the point I was making. And we're told that a good return can be expected if the underlying asset moves in a narrow range, because you just pocket the premium. The underlying option is not exercised. However, losses will be incurred if the asset price moves in the opposite direction to that expected, because the option will be exercised. And we're told the loss can be substantial, so there's a heavy degree of risk here. When a bullish note, the price of the underlying falls significantly, goes against what you expected, and the opposite with the bearish note. 4.2 at the top of page 3.12, we consider equity-linked instruments. And I said, while the notes are OTC over the counter, the instruments, equity-linked instruments, are traded on the stock exchange. Now, price quotations, as with anything traded on an exchange, on a real-time basis, so there's better price transparency as well as higher liquidity for these instruments compared to the notes. The instrument's similar exercise price and times to expiry can be compared with implied volatilities of embedded options, and that will be the difference in the pricing. And the higher the implied volatility, the higher perceived risk of large price movements. So the equity-linked instrument, very similar to the equity-linked note, except it is traded on exchange, bringing with it transparency, price transparency, and higher liquidity. And those are the points that may be highlighted in an exam question. Let's finish off this part of topic 3 by looking at callable range accrual note. Comes with two features. It's callable, that is, the principal can be repaid, so that introduces reinvestment risk because suddenly you get your money back. And the underlying asset is usually a basket of stocks. Now, two coupons will be paid, depending on the situation of the underlying. It can be a high coupon, maximum coupon rate, and a low coupon, the minimum. The maximum coupon rate applies as long as all stocks in the underlying stock basket fall inside predetermined range of prices. So if they don't move too far, you'll get the maximum coupon. If any one of the stocks, the underlying stock basket, falls outside the range on any day, minimum coupon rate will apply for that day instead. So you're getting a daily payment. Thus, coupon rate varies on a daily basis depending on the varying prices of the basket of stocks. That's what I've just said. Now, a triggering event occurs if fixing values of any of the stocks in the underlying stock basket are at or above their respective callable prices. Remember, that was one of the features of this note. They're callable. On any scheduled observation date, the note will be terminated and will mature immediately. That means as an investor, suddenly you get your money back. An investor who invests in a callable range accrual note expects stock prices will trade within the predefined range. That's what the view you have taken, and that stock prices are unlikely to fall below their respective reference values. Now, benefits to investors of these instruments: high coupons received on a daily basis if stock prices remain within the predetermined range. So that's why it's called a callable range accrual note. Risk for the investors: low coupons received if any of the stocks in the underlying basket trade outside the range during the tenor of the note, and reinvestment risk if the note is called, that is, you get your money back. Callable range accrual note, could that be examined? It could be compared to other products, or it could be examined in itself, but I wouldn't see any more than one question if they decided to examine that aspect.